This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello. Well, we've talked a lot about pension accounting. Just to finish off with this accounting standard, it does deal with certain other employment benefits of which you should be aware. So, one of them is short-term benefits. In particular, you need to understand the accounting for holiday pay. If you have a bookkeeping job at the moment, you perhaps see this in practice. So I work at the company and I'm allowed 4 weeks off every year for which the employer pays me. Now, sometimes the employee can be very enthusiastic and they don't want to take their holiday. Well, then it's up to the employer whether the employee can carry the holiday forward until the next year. So perhaps you're planning a big trip in the second year, so you don't take all of your holiday in the first year. Now, if you can imagine, perhaps I work at the pie factory, stuffing pies, stuffing whatever. What do you put in pies? Sago? I don't know. You put the stuff in the pie, don't you? Anyway, so here you are. In the first year, you do an extra 2 weeks of pie stuffing because you want to take 2 weeks extra off in the second year. In the first year, the employer gets 2 weeks extra worth of pies. And in the next year, the employer gets 2 weeks less worth of pies. So you work harder in the first year, less hard in the second, if that's what the rules allow. Well, the matching concept says match cost and benefit. What you are doing is producing more goods in the first year and less in the second. So at the end of the first year, they'll make an accrual again for the extra work that you've done. That can then be reversed in the second year. You can see if you look in the course notes, the adjustment here, there it is. The adjustment again will be to debit wage expense, credit accrual. So it's a simple adjustment that allows the employer to match the cost against the benefit of the extra work that you've done. The other topic is long-term benefits. And in particular, again, this is probably things where, for example, the employee unfortunately loses the ability to work or the ability to work as well, and the employer, through the contract, says, I will support you again through your long-term illness. So there's some kind of long-term disability payment being made. Now that could, of course, go on for many years. So the question is, how do you do the accounting? The answer is you do the accounting in the same way as pensions. So you do have very similar costs to those with defined benefit pension schemes. But on this type of plan, the uncertainties will not be as significant. So you won't get enormous remeasurement differences. So the only real difference with these schemes then is that remeasurement differences do not have to go in other comprehensive income. They're simply recognised in the profit and loss. Now remember, with this, as with pensions, you're not sitting an exam to be an actuary, so don't worry about the jargon. You won't be asked to write about actuarial assumptions. All you have to do is explain the accounting. So you'll be given most of the numbers, and then you just have to say, this is what goes in the P&L, this is what goes in the balance sheet, and a lot of that is simply copying. So be calm with pensions and with other employment benefits. Thank you.